Pomp, the man who needs no introduction. Finally, I get you on Real Vision.
Thank you so much for having me. We've been planning on this for a while.
I know. It's just before we had to do things in camera and in person. It was a fucking nightmare. And now we just do Zoom. You're in Miami. I'm in the Cayman Islands. It's easy.
Absolutely. I'm excited to do it.
So listen, I want to do something a bit different with you because you get a lot of sound bites. You're all over the place. I want to hear the Pomp story. I want to know who you are, where you've come from, how did you get here, all of that stuff. So let's start at the beginning. Where did you come from? Go for it.
I have a mother, and at one point she decided to have a child.
She probably regrets that by now.
Oh, she definitely does. No, I was born in Hollywood, Florida. We lived in Lakeland and Cooper City, and then we moved to Raleigh, North Carolina when I was young, I don't know, 7, 8 years old, whatever it was. The oldest of 5 brothers in my family, and all of the good and the bad that came with that for my parents probably gave them nightmares at night, but also they loved every second of it. I ended up going and playing football at Bucknell University, studied economics and sociology there, and then was in the military, did 6.5 years in the military, did deployment overseas, came back.
What age did you come back from the military?
So I signed up when I was 17. I needed my parents' signature to sign up. And I basically signed up with the National Guard. And I knew that I was going to go to college. I was going to go play football. And then basically I would just owe some time like after school. But what ended up happening is I got deployed when I was a junior in college. Literally like 2 weeks into the school year, I got a phone call and they said, hey, you're going to Iraq with this unit. And I was like, no, I'm not. I'm going to go play the football game on Saturday. And they were like, that's not how this works. So ended up doing that. I was 20 years old when I got deployed in 2008 and was there kind of total deployment 13 months.
Where did you end up?
I went to Taji, Iraq, which is about like 12 miles north of Baghdad. We did basically night route clearance. So we drove along the roads super slow, like 5-7 miles an hour, and looked for roadside bombs and ambushes. We basically would go out in front of the resupply runs or other soldiers and try to sniff out kind of all of the danger. So we're driving in the middle of the night with all our lights on and kind of slow. And then they'd come behind us and they'd get to go 60, 70 miles an hour with all their lights off and just try to beat people with speeds. So was
that not terrifying? You're a kid, you get sent there, you think you're going to be playing football, next minute you're trying not to be blown up at the side of the road.
When you're 20, you think you're invincible, right? So there's an element of, hey, this is fun. And the best part about the experience, honestly, was, I got deployed. I was by far, I think I was like the youngest guy, if not, at least 5 years, if not more. Most of the guys I was there with, I'm pretty sure were kind of late 20s into their early 30s. And these guys had families, they were married, they had kids, they had mortgages. I was basically just a young idiot kid who had been in college and was worried about, the football game on Saturday or the party on Friday night. And so to kind of get thrown into this environment where not only are you around a bunch of, pretty mature men who are in the middle of like living an adult life, but also in a situation of danger. And in many cases, I was in charge of some of those guys. It just was a situation where you got to grow up really fast, right? And you kind of learn very quickly, like you can be the big smart ass all you want. You can be the funny guy, but at the end of the day, like...
Hi, I'm Raoul. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
Situation where you got to grow up really fast, right? And you kind of learn very quickly, like you can be the big smart ass all you want. You can be the funny guy, but at the end of the day, like you got to be an adult, right? And so it was probably a really positive experience in hindsight, but at the time you're just 20-year-old kid running around with a gun in the desert, and you frankly are too stupid to realize how dangerous it is.
So what made you leave?
Once you do like 6.5 years, basically. So that was one contract. If you sign a second contract, you're probably going to end up doing, over 10 years. And everyone always talks about 20 years is when you get to retire. And so like, if you're already halfway over, then pretty much like, why would you not just finish it out? And so I knew that if I signed a second contract, I probably would stay. And I just didn't really have the desire really, frankly, to kind of do it for 20 years. And on top of that, when I came back from Iraq, I was on a soldier's salary, which basically is not that great, except for when you're overseas, it's tax free. And I came back, and on the way transitioning back in Kuwait, they have all the defense contractors, and they basically sit there and they say, hey, if you go right back for 6 months, we'll pay you $90,000. And if you stay the whole 6 months and don't go home at all, we'll pay you a 10K bonus. You get 100K. Or if you do it for 12 months, we'll pay you 180 with a 20K bonus. You get 200,000. Pretty much guys are sitting there saying, wait a minute, you're going to pay me a lot more for doing exactly what I just did. And maybe I might actually be safer and might be better food and better accommodations. Like, it's pretty compelling. But my father had a, very clear conversation with me that was, you're not going back. You're going to go back and finish school. And so that's what I did.
So you finished school, your experience is now all in the military. What do you decide to do?
A weird experience was when I went back, I basically missed 3 semesters. And so I went back to school. Basically my class that I went into college with, they were graduating. So I went back kind of the second semester, senior year. They're all basically checked out, ready to leave. And I'm staring at 4 more semesters of school. I frankly don't know anybody other than my friends who are leaving. And so I had to kind of reestablish friendships. I kept playing football, which was great and really kind of helped with the transition back from the military. And in the last semester that I was there, I ended up doing the full 4 semesters of work in 3 semesters. But in that 3rd semester, my dad called me again. He was just like, look, you got to either go get a job or you can make a job. And I was like, well, getting a job sounds dumb. I don't want to do that. It's like, let's make a job. And he was like, well, you could start a business. And I was like, okay, how do I do that? And just like in hindsight, so dumb. And he just walked me through it. He was like, look, basically you can go work for somebody or you can create a company and people work for you.
What did he do? How did he know how to do this?
He basically lived 2 lives. So his first life was he worked for 25 years at MCI and then AT&T, rose up, literally the classic story of like him, his father, his brothers, kind of his whole family worked in a single company and kind of did the corporate thing for decades. And then as he got older, he ended up basically becoming like a technology executive, working for companies that other people had started, and then started his own companies. And so he kind of really got bit by the entrepreneurial bug, and he never really pushed it on my brothers or I, but he definitely, I think, wasn't there to discourage us if that's what we wanted to pursue. So it was kind of the perfect way, I think, to say, hey, look, if you're interested in this, I'll encourage it, but I'm not going to, tell you to go do this. And so that's what I did. Me and 3 buddies from high school, we created a company. It was literally every mistake you could possibly make in the book, but it was in the online advertising space. And then there was a second company.
But why did you start the online advertising space? I mean, you knew fuck about fuck, if I put it correctly.
Literally, if I started to explain how these things come together, like we knew that in the local community around the university, basically all of the local businesses wanted to advertise inside the school. So basically there was 3 main employers in this little town in Pennsylvania, in central Pennsylvania. It was the local school district, the Pomp School District. There was a local hospital or the university. And those were basically the 3 main employers. And small businesses, if you're a local pizza shop or whatever, you basically want to advertise in those 3 places because that's where you're going to get the most eyeballs. But the school districts had a very antiquated kind of advertising system where literally there was pamphlets on a table. And in order to get approved, there was like a archaic process. Like you had to send in your pamphlet, all stuff. These guys are like, look, man, I'm trying to figure out what the special is on Friday, let alone trying to plan 6 weeks in advance. And so we just got the idea of like, why don't we just create an online directory? And so as we kind of learned more about these public school districts, still to this day, one of the most popular, most visited websites in the world are the portals where parents sign in to check their students' grades, their assignments, their conduct, all that kind of stuff. But the schools don't monetize it, right? The schools aren't in the business of monetizing it. So rarely on the internet do you find a high traffic website that's not monetized. But literally every school district in America has it sometimes, hundreds of thousands, if not millions of page views on these sites where parents sign in. And so we started going around the country, going to these school districts saying, hey, look, put this hyperlink on that page. It looks very professional. And it'll link to a local business directory, kind of like what a Yelp is. And we'll go sign up the schools or the local businesses. And if they pay us, I think it was like $15 a month, we'll basically split it with you. We'll give you $10 and we'll keep $5 for ourselves. And so we got free traffic from the school. They got a free check of money, right, for just putting a link on their website. And then the small businesses got to advertise in front of, the parents and students in the school district. And so, probably a pretty decent idea, horrible execution. Literally every single possible thing we could do wrong, we did. And we ended up learning a lot from it, which was probably the most valuable part of it. But that's really what kind of kicked me off down the road of technology and company and investing.
So what did you do after that? What did you do with that business? You shut it down? You sell it?
We basically, we sold it, and I put that in air quotes because I think that like we basically got back just enough cash to like cover what we had invested. So definitely didn't get rich off of it, but again, just kind of like literally went through the entire life cycle of a business on a very small scale, and just learned a lot. And from there, I then started a second business. That business did a little bit better. That was online online data. And so if you think about this is in like 2012, maybe, all the APIs of these social media companies were wide open. So you could literally ping Twitter and say, hey, give me all the tweets within a 3-mile radius of this GPS coordinate, right? And they would literally just dump all the tweets to you. And so what we did was we basically came up with a piece of technology called identity stitching. So one of the problems back then was there wasn't a lot of context. So if Raoul goes and he tweets, I love ice cream, that's not very helpful for an advertiser, for a sports team, for the military, for law enforcement, for anybody. But if instead we know that you just checked in on Foursquare 3 minutes ago at an ice cream store, and then you say, I love ice cream, and we can, kind of stitch that together, now all of a sudden that tweet's much more valuable because either a competitor wants to know that or that business or whatever. And so what we started to do was just figure out all these little things. How do you stitch together various social profiles? And so, you may sign up with the same email address on multiple accounts. Well, now we can match them. You may use the same profile. You may use the same name. You may use the same URL in the profile. And so we just started trying to figure out how to stitch it together. And we were basically selling into sports and entertainment venues. They really wanted to know like who's in our stadium, right? If you've got somebody, this is before kind of influencers and all this stuff, but if you've got somebody with a big following and they're talking about your team, you might want to give them a special experience, bring them in the locker room, give them a discount or whatever. And then also law enforcement and military. And so if you kind of think of a police use case, they call it digital canvassing. So if a shooting happens on the street corner, when they show up, pretty much everybody ran. There was a shooting, so everyone took off. And so historically, they just gone to local shop owners or residents and said, did you see anything? But now what they could do is they could basically say, hey, show us all of the social media content that had been created in a 2-block radius in the last 3 hours. And if you had created content, they could see that. And so that whole business led me to eventually I met some people at Facebook. And I ended up actually working at Facebook kind of after that business. But it was just a really interesting time in kind of the early 2010s, just seeing social media, how fast this stuff was growing, how important it was going to be for society. And frankly, it was a lot of fun.
And what did you do at Facebook? That must have been a big shock because you didn't want to work for anybody, and now you're back into a monster. I guess it was a bit smaller back then.
Yeah, I joined, I think it was like 4,000 employees, just under 4,000 employees. The two stories I always tell about Facebook. So one is when you use these products, especially when you're younger, before kind of, technology, entrepreneurship got so celebritized, you forget that there's employees and there's buildings and there's like a company behind it, right? You're just kind of using this faceless, nameless product. And so I remember when I went out to California, it was the first time as a kind of teenager or older that I'd gone to California. I went to San Francisco. I knew nobody, and I went on the campus, and I remember just being blown away by kind of how exciting and fast paced and how smart everyone was, how ambitious they were, and so pretty much on the spot, I was like, "Yeah, I would love to work here. Like this is amazing." And so I ended up running the growth team for Facebook pages. If you think of Facebook pages, basically the top of the advertising funnel or the top of the funnel for their business product, you have to have a Facebook page to become an advertiser. And so in 2014, I basically stepped into a job as a product manager. Nobody had really worked on growing that product. And I think I started out with a team of like 6 or 8 people. And over about a 12-month period, we grew to over 30 people, 2 offices, and ended up driving quite a bit of revenue to the bottom line. Stock price takes off. And as with everything in life, you probably get too much credit when things go right and you get too much blame when things go wrong. But then had a couple of other opportunities at Facebook after that. But that's where I started.
And then, so after Facebook, where'd you go?
I went to Snapchat. I was there for a very short period of time. And then in 2016, I started to invest full time. And that was probably, the big decision was like, hey, do I want to keep building companies, whether I'm the founder or helping other people build them, or do I want to invest? And, for whatever reason in 2016 decided I think I want to spend a lot of time investing.
Here's a nice connecting theme: is you go into the military knowing nothing about being in the military. You then start an advertising business knowing nothing about the advertising industry. And now you're about to walk in investing. What makes you think you have any idea what to do there?
I think that it's 2 things, right? So one is just like, I'll bet on myself all day long. And some people see that as arrogant. Some people see that as a level of self-confidence. I actually look at it the exact opposite, which is when you bet on yourself, what you're really betting on is your ability to learn. Right. I mean, that's all betting on yourself is, hey, I'm going into this knowing that I don't know very much about it, but I'm willing to bet that I can get up to speed very quickly. And not only will I be above average at it, but I think I can be good at it. Right. And so that's just having the intellectual honesty to, 1, recognize you don't know anything about it. 2, understanding that there's a lot of people who do know what they're doing, and you probably should go find those people and learn from them. And then 3 is also having the patience and discipline to realize like it's just going to take reps. Right. And so like, how do you basically get the reps in a low risk situation first before you kind of move on to bigger and bigger things? And so that's literally how I started, was myself and a gentleman named Jason Williams, who had previously sold a pretty large healthcare company for about $500 million. We started essentially angel investing is really what it was, kind of $50,000, $100,000 checks in technology companies. And we said, look, let's see if we can figure this out. Like, let's see if we can do it. Let's see if we can enjoy it.
So you start with a blank P&L, no portfolio, not really sure what to look for. How do you start?
Yeah. So there was 3 things we did. One, I had the benefit of I had worked in Silicon Valley for a couple of years. And so I knew some people. I didn't have a great network, but I knew enough people where I could basically call them up and say, hey, have you seen any interesting deals? And they would say, yeah, there's this like great deal. And so unbeknownst to me at the time, like there was some like really good deals that we ended up getting into just because a friend of a friend or a friend was investing. And so in that first portfolio, it was only like a $3.5 million fund, right? Which like compared to most people, they're just like, why would you even do that? But we didn't know how much money we could raise. We didn't know anything, right? And so we were literally seed investing in these deals. And today, 2 of those companies are now worth over $1 billion. Where we're seed investors. We've got a couple that are worth, hundreds of millions of dollars. And in hindsight, we started off fast, right? At the time, it doesn't feel like that because you're like, I have no clue if this is something we're good at, if we're going to enjoy it. And also the feedback loop takes a long time in venture investing, right? It's not like you make a decision today and tomorrow the price moves up or down and you know whether you were right or not, right? It's not like kind of, trading. Instead, it was, we're going to invest today. We're going to invest a ton of time working with these founders. And then we'll find out in 3, 4, 5 years whether these decisions actually worked out or not. And so, now we're starting to see some of those data points and it's really, really compelling. But there was a good number of years there where you just got to have blind faith that, hey, I made sound decisions based on the information I had at the time. And as long as I continue to help the founders, it'll work out.
So what's the maths behind you think of VC portfolio? Is it kind of 80% zeros? My guess has been something like 80% zeros, 18% kind of okays, and 2% knock out the park winners, makes all the P&L. How do you think it played out over time?
Yeah, so it's I think a little difficult or a little different depending on the stage that you invest in, right? So if you're a really, really early stage investor, you're more likely to have more losses than, let's say, if you're a growth stage investor and kind of everywhere in between. The one thing that I will say is I think that the losses are probably overblown. So it's probably not 80, 90% type losses. Like everyone always says, 1 in 10. It's probably something more like maybe the top 10% or even 5%, they drive 90% of the returns. And then there's a big middle gap, right? So you might talk about out of every 10 investments, maybe 1 is the outlier. Then you've got 6 or 7 that are kind of singles or doubles. So maybe you either get your money back or maybe you kind of, 2 or 3 exit. And then there's the ones that go out of business as well. And so I think that the fallacy of like 80% go to zero, directionally it's correct or philosophically it's correct, but the numbers are actually a little bit kinder to venture investors. And as I started doing it again, going into it completely uneducated was actually a huge blessing. There's a lot of people that I've met over the years where they were a young person. I started doing this when I was 26, 27 years old, like 27 years old maybe. And they had spent 3 or 4 years working for like a legacy venture firm. And so they had learned a certain process. They had learned really kind of a risk mitigation strategy, right? If you think about kind of a traditional venture diligence process, it actually is somewhat pessimistic in its execution, because what you're constantly looking for is you're looking for all the reasons why a deal potentially couldn't work, right? You're trying to find that red flag. I'm naturally an optimist. And so I went into it saying like convince me the possibility, and that's good enough. I don't want to do the diligence on all the ways it can go wrong. I want to do all the diligence on the ways it could go right. And so again, I didn't know that was like a good thing. Now in hindsight, like I understand like that's actually a really, really important component of what we did. And then we started to deploy capital, and you quickly realize like nothing the founder tells you at the pre-seed and seed level matters other than who they are. Like literally nothing, right? And so if you look at everything from, Lyft, Uber, Airbnb, all kind of the big winners, all the way down to companies in our portfolio, like if you bet on the right founder, they'll win. And, now I've invested in a number of unicorns at the seed stage. And it's the one thing that, I constantly go back to is just find the right founder going after a massive market. I'll bet all day long. And people underestimate how asymmetric these investments are, right? We're not talking about, the investment could go up 5x, 10x, 15x. We're talking about investments that have 100+ X type potential if you end up investing in, what become multi-billion-dollar companies. And so I think that the technology background I had in growth at Facebook really allowed me to understand kind of the exponential nature or kind of the parabolic nature of some of these types of investments. When we get to Bitcoin, that definitely is an advantage I have. And so it was just like, look, go find the best founders. Who cares what the valuation is?
What defines the best founder? What is for you? I mean, different people have different criteria. What selects one founder versus another for you?
It's a problem solver. That's all it is, right? Like if you really think about building a business, vision's important, recruiting's important, the ability to fundraise is important. The idea is actually, somewhat important in terms of like you got to make the right decisions about what markets to go after, all that kind of stuff. But if you're a problem solver and you have critical thinking skills, you can think from first principles, you're an independent thinker, you are going to get all those other decisions right. Right. And so like a good founder rarely goes after a bad market, right? Now they may make mistakes, they may do these things, but like the decision-making framework that they use will normally get them into the right markets. It'll get them good people around them. It'll get them capital, and then it'll get kind of out in front of customers. And so things can go wrong, but really what you're trying to figure out is just, can this person make decisions with a lack of information in an uncertain environment? And do they have a propensity to solve problems? And so the way I always talk about it is like, when something comes up, there's two types of people. If all of a sudden you get an email and that email has an issue, there's people who read the email, don't answer it, and then they wait 2 days and then they try to go answer it later. And like, they're very much in the defensive mode. And then there's people who they get an email and there's a problem and they immediately pick up the phone and they call the person and say, hey, how do we solve this? Those two people are very, very different. And I think you always want that the second person, the person who will call and kind of be offensive in nature, because what it does is it really allows you to take something that is frankly valueless in the beginning. It's usually an idea with one or two people and create something that's massive because they just solve every problem along the way so that they kind of earn the right to continue the journey.
Okay, you're now in the VC world. You're learning how to do stuff. Where does crypto come into this? How does this discovery happen?
Polina, my wife, wishes that it never came along because then I wouldn't be thinking about it all the time. But so in 2014, I think it was, or either end of 14 or beginning of 15, working at Facebook, we hired David Marcus. He was the president of PayPal. He comes over and he's going to run our Messenger product, kind of the messaging app that got spun out of Facebook proper. And it's the first time I ever hear about Bitcoin. So relatively late compared to most people even hearing about it. And David kept talking about it from a remittance standpoint. Could we put this into the application? Hey, this is really interesting. Now, I didn't know at the time, but have since come to find out David and a couple other guys had bought a bunch of Bitcoin. And so there's a book, Digital Gold. You can go read about kind of their journey. But they really understood it and were really excited about it very early on. And so I heard him talking about it. He wasn't necessarily telling me personally about it. He was more just talking about it in the office. And so I turned to an engineer and I was like, what is this? And, as one of the great mistakes in life, the engineer said, it's stupid. And so I said, okay. And I just went about my day. I didn't Google it. I just did nothing, right? And so lesson number one, when smart people are really excited about something, pay attention, but just didn't do anything. And so the next time I kind of came in contact with it was in 2016 when I started investing. There was a kid, JP Barrick. I'd met him when he was in high school, and he was now a freshman in college. And he said, can we meet for some coffee? We sat down and he said, you've got to pay attention to this. And I was like, what is this? And he wasn't so much pitching me on Bitcoin and Ether from an asset perspective. He was really interested in the mining business. And so I understood data centers. My father, that's what he did at MCI, AT&T and all that. And so I understood that business. And when I saw crypto mining or Bitcoin mining, immediately it was this is a data center on steroids, right? I have persistent customer demand. So I always know that 100% of my computing power will be monetized because there's always demand. Two is I don't need a sales force. I don't need a lot of the administrative staff, all the things that change the cost structure in those data center businesses. That's all removed because it's an automatic, persistent demand for the computing power. And then three is the starting cost for something like this is very low, right? Most data center businesses, you're talking about SOC 2 qualified tier 3 data centers, very expensive square footage. You got to have certain cages and you got to have all sorts of licenses and approvals. And just there's a big cost of either building that or going into some of those kind of approved tier 3 spaces. With this in Bitcoin and Ether mining, literally people were doing it in their basement, right? They were doing it in what we used to call chicken coop mining facilities. They literally just found an outlet where they could plug into, they had internet and they would start mining. And so the entire cost structure of what used to be a data center was now getting flipped on its head and people were making a lot of money. And so I took a little bit of personal money. Actually, I've never even told a story before. I sold my Facebook stock at the time and, said, okay, I'm going to take half of it. I'm going to put it in my bank account. The other half I'm going to take and I'm going to go put into this crypto mining stuff. And I bought a couple of miners. We put it in a kind of hosted facility, and there was a dashboard. And you could essentially look at that dashboard at any point and see how much computing power you had. You could see how much ether was coming in, and you could see kind of the price fluctuations. So what that meant was, kind of what your balance sheet was equal to. And so by the time I actually buy the equipment, I get it set up again, I know nothing going into this. It's like beginning of 2017. And I have no historical context to halvings or market cycles or anything. And we start mining. And all of a sudden, Ethereum goes from like $8 to 10, then from 10 to 30, and then 30 to 100. And the entire time, like every day, like I'm mining Ether. And I'm sitting there saying like, in April, it was like $10 by May, or like maybe it was March, it was like $10 to 30, and then from 30 to 100 by like May.
Were your mining costs the same? They hadn't gone up? Or they gone up a bit?
Nope, exactly the same. So not only am I mining profitably, and it's like a cash flow machine, I'm getting paid every day, but then also my balance sheet is expanding. So if I had, use easy numbers, if I had 10 Ether, they were worth $10 each. And next thing you know, 3 weeks later, it's 10 Ether worth $30 each. Like you're essentially making money on your balance sheet, plus you're also getting more and more cash flow. And so I just became fascinated. I was like, holy shit, like, what is this? And so I just started spending way more time looking at this. And what I started to realize by kind of educating myself was like, this is exactly what Facebook was. This is exactly what Twitter was. This is exactly what Airbnb and Uber and all these things.
Metcalfe's law in this, essentially.
I didn't know how to articulate that, but I could see, because I ran these growth teams, I understood the analytics that went into kind of viral products, right? So when I saw Facebook and I started to think about it, and I had some context from like Venmo, kind of watching them grow. I'd read a lot about PayPal and kind of PayPal mafia. And so kind of the virality of money and how quickly it can kind of really drive adoption. And so the more and more I looked and focused and kind of educated myself on this stuff, I just said, oh my God, like the entire world is underestimating this thing because they don't understand, they don't think in these exponential terms. And so, I always say like Wall Street thinks linearly, right? They're always constantly saying like, what's month over month growth? What's, year over year growth? And for a business to do more than, I don't know, 20, 30, 50, maybe 100% month year over year growth is pretty rare. In this case, we were talking about, especially in 2017, it 20x, right? And so it was just like, oh, here we go. And I'd seen enough viral products to realize like this thing is going to be, something that is much bigger than people expect. And so by the end of 2017, I pretty much decided I don't want to do venture investing across all of these sectors because I can't focus enough on just crypto. I need to go spend all my time on this. And so once I deployed kind of that first fund with Jason, we started trying to figure out, okay, how do we go and basically invest just in this one industry? And eventually kind of did a couple of things to be able to position ourselves to do it.
And so crypto winter happens. I guess it's the right time for you because you're actually deploying capital into that period. Obviously slightly terrifying because you don't know whether your hypothesis is completely false or not. How does that work?
Yeah, so in the technology world, one of the things that was fascinating to me, and frankly, it was fascinating because I didn't have enough capital invested to really feel the pain, but it broke every kind of preconceived notion I had. So when a network effect business really takes off, it's nearly impossible to break the network effect, right? A true network effect business, once it gets going, it just doesn't break. And so when Bitcoin started to take off in 2017, right, it's a network effect, right? It's going to keep going. Like there's no way that it can basically break out of that. And so when 18 kind of happened and the market turned over, it completely changed the way that I looked at network effects and virality and a lot of this stuff. And so I was able to take some of the lessons I had learned, but now realize that price is different than the true value of the network. And so by separating those two things, the network effect of and the value of the network can continue the way that you would expect technology adoption to occur. But this price component is a completely separate yet related thing. And so in 2018, Jason and I partnered up with Mark Yusko, right, who you know very well. And Mark's got Morgan Creek Capital Management. And Jason and I basically had learned two lessons in venture investing. We said, one, we had no follow-on capital. So we made great investments, right? Two companies ended up being unicorns in that first portfolio, but we had no follow-ons. And so we were basically taking dilution on the chin. And so we said, we got to get follow-on capital. And two was in 2017, everyone and their mom was running ICOs. They were raising money from family offices and retail, and it was absolute bonkers free-for-all. And for whatever reason, from day one, we said, these ICOs are all garbage. We think people are going to get in trouble. We don't think that's the right group to go raise money from because they're going to have really, really emotional reactions, whether it works or it doesn't work. And so institutional capital is going to kind of be the holy grail here. And so when I met Mark, I basically sat down with him and I said, look, I understand this stuff pretty well. I think that I've got pretty good deal flow and I can get us into a lot of great deals. You have the institutional relationships. You can provide a lot of legitimacy to this. And so if we team up in some way, I think we can, one, raise institutional capital. And then two is I think we can go make a lot of money for those LPs by deploying it into this space. And so in 2018, we went out and we raised the first fund. Publicly it's known, it's about a $40 million fund. But the key to the whole thing was the first two U.S. public pensions in the United States invested in a dedicated blockchain or crypto fund. And so these two public pension funds end up investing, and then they were joined by a hospital system, an insurance company, a private foundation, all of the kind of traditional institutional LPs. Small fund, but really important that those were the types of limited partners that we had in the fund. And so we went out and we basically did two things. We put, I think in that fund, it's like, 15% of it in Bitcoin. And then we went and we started investing in the infrastructure of the industry. And so, in that fund, there's investments in Coinbase, Figure Technologies, BlockFi, eToro, a whole bunch of different companies. And so what we kind of got a front row seat to was like, oh, these guys really, really want exposure to this industry. They may not come in and just buy Bitcoin directly from day one. They're going to want a holistic exposure. They're going to want stocks, bonds, currency, and commodity exposure to kind of this digital asset space. And so our pitch basically evolved into, look, every stock, bond, currency, and commodity will be digitized in the future. And your entire portfolio as an institution will be digital in the future. So you have digital stocks, digital bonds, digital currencies, digital commodities, and you're likely to buy the exact same asset from the same counterparty. It's just in a new technology form factor. And so the framework that we used was go back to kind of pre-1970s, 1980s. And what you find is everything was analog. So literally people would open outcry method on the stock exchange floor. You'd get the physical mortgage or deed to a home. You would have physical currencies, all this stuff. But there's a transition to what I call the electronic age of securities, right? So we got electronic QSIPs. There's electronic QSIPs, same asset. It's the same, deed. It's the same stock certificate. It's the same currency. Now it's just in a new technology form factor. And that unlocked immense global value. And so the institutions that were early to recognizing this and also had the courage and conviction to act had a massive advantage for a number of years, right? They were able to generate alpha, still buying the same asset, still buying from the same counterparty, new technology form factor. And then over time, it got commoditized down, right? So literally the best example is like the guy who was picking up his phone and calling a stockbroker to run over on the stock exchange floor and open outcry, buy or sell stock, had a disadvantage compared to the first couple of institutions that figured out I can execute the same trade on my computer. Right. And so we said to institutions like, hey, we're going to move from electronic world to a digital world. And when that happens, if you're early to understanding that and capitalizing on it, you'll be able to generate outsized returns because you're going to get in before it gets commoditized. Right. And eventually everyone will do this, but being early will be important. And so, we had a couple of, frankly, courageous and just very forward thinking, courageous CIOs who said, yeah, I buy into that. I agree with it and I want to be a part of this. And so we started investing capital on behalf of them in 2018.
Are you still part of Morgan Creek or not any longer?
Yeah. So basically, the first two funds that we raised, it's about $110 million, give or take, across Fund One and Fund Two. So I'm still a general partner there. And then for the next fund, I've gone out to do it under my own name, and we can talk about kind of some of the advantages of doing it under your own name versus under an institution as well.
Yeah, I'd love to hear what you're up to now in that side. We'll go into a bunch of other stuff, but yeah, how you think about this whole space now in terms of the VC investing side in it, and what are you up to?
Yeah, so I think that one of the key differences or kind of evolutions that the world's gone through recently is the barrier to entry and the friction for individuals building audiences and building brands has drastically been reduced. And so I've been fortunate over the last 3 or 4 years to build some pretty large audiences, and it's kind of grown into a pretty attractive business in itself. But what I started to understand and was lucky enough to have a number of people way smarter than me kind of talk me through was, look, there's going to be a point, and starting now, but it'll get more popular over time, where founders, they're not going to want to take money from the institutions. They want individuals, right? The individual actually can bring more value and can bring a greater brand awareness than an institution. Now, that doesn't mean that all the institutions go away, right? In venture capital, for example, Benchmark, Sequoia, Andreessen, those guys are absolute tier one, best of the best, world-class investors, and those institutions will persist. But what happens to all of the tier two and tier three investors is, if a founder is faced at a pre-seed or seed level with taking money from an individual with a very large audience that can bring awareness, signal, and value versus take it from an institution, more and more these founders are deciding, I want to take it from the individual rather than the institution.
But what made you think this? What made you realize that this was a new path that could happen?
I started to realize it, I think, when just talking to founders in general, like founders would introduce me to other investors after I invested in the company, and they would reference me rather than the institution. And for me, that was always weird. Like, why would you do that? Start asking them, And as part of that, I got enough data points where it was like, oh, the individual partner at an institution is more important than the institution. It's basically what the feedback was. And then I got a phone call from an individual who very well known in Silicon Valley. And he basically said, look, you should go do this for yourself. And you should do it under your own name. And that's a really, really valuable, defendable thing. And I think there would be significant advantages for you to go do that. And so I frankly just kind of got thrown down this rabbit hole and started thinking more and more about it. I started calling a number of people I knew and just asking them what they thought about it. And I pretty much called, I would say, either the 3 smartest or the 3 richest people I knew, right? I just kept calling, I was like, hey, you're smart and rich. Like, what do you think? And 2 of the 3 conversations literally had the same response, which was, why haven't you done this already? Right? It was like, it wasn't even a debate. It was just like, of course you should go do this. And so I just took it to heart and I said, look, let's go try it. I think it's less about like me specifically. And it's just more of like, this is going to be the trend, right? You're going to see a ton of these solo capitalists who say, look, in the past, you either had to have a big exit as an entrepreneur, you had to have been a partner somewhere so that you had a big windfall, then you had a capital base and you would just invest your own money. But now what's going to happen is there are going to be LPs, whether they're institutional or not, that want to back individual managers and they want them to invest under their own name. So on a cap table, it's no longer the institution's name, it's just Pomp, right? And the value that can come from that over time is people seek out the individual. Right? They want that individual. And, if you look in Silicon Valley, there's a ton of people who've done a very, very good job of this in kind of the angel or pre-seed stage.
Tim Ferriss pioneered a lot of this as well.
Tim Ferriss, Naval Ravikant, right? A bunch of these guys have done a fantastic job of this. And they've been very, very successful in doing it. But I think that now what we're realizing is whether you're an investment manager, you're a corporation, or you're an individual, you got to have your own distribution. You got to have your own audience and you got to do things under your own name. You've got to own the success or failure under your own name. And if you're good, you'll be rewarded, right? And so I had already kind of accidentally backed into, I had massive distribution, I had a big audience, and I was willing to take the personal risk of doing it under my own name. And so I ended up using an angelless rolling fund, which is kind of a nuanced fund structure.
How does that work?
So basically, if you think of a traditional fund, a GP goes out, they spend 6 months fundraising, and let's say they raise $10 million, right? And they say, okay, I have a $10 million fund, and now I want to, call the capital, but I'm going to do the capital calls infrequently, and I'm going to do them at variable amounts. So if Raoul is a LP in my fund, I may say, okay, 2 months after I've closed the fund, will you please send me 10% of the capital? And then I wait 6 months, and then I call 7% of the capital. Then I wait another 3 months and I call 20% of the capital, right? And it's kind of an infrequent variable amount and time every time. And so when that occurs, it's really hard for LPs to do cash management. Right now, a good GP will they'll explain to the LP what's going to happen in a couple of months, and they're good, but not everyone does that. So that was kind of problem number one. Problem number two was the GP raises money for 6 months, and they may not go out to fundraise again for 2 years. And so during that 2-year period, if the LP and the GP meet, there's no ability for the LP to invest in the GP. There's no ability for the GP to take money. And so what the rolling fund structure basically said was, we're going to go find individuals, take myself, we're going to use software as the back end, and then we're going to create this rolling-like structure, which means that Pomp can take in money every quarter, regardless of how much he's raised in the past or what he wants to do in the future. LPs can persistently commit to his fund. And rather than commit a set amount and then not know when the capital call is coming and for how much, Pomp is just going to call a equal amount of their commitment every quarter. So if you commit and say, hey, I'm going to do $100,000 a year, every quarter you're going to get a $25,000 capital call.
But isn't that complicated because different people are going to get in at different prices into different assets and different investments? And do you not have to keep a huge spreadsheet of everybody and what they've got?
You are an absolute pro, because that is one of the complexities of this. Now, AngelList has done a great job. They've built a bunch of software for this. And the way that they protect the LP is they say each quarter is essentially a separate fund, but they're cross-collateralized. And what that basically means is if you invest, and let's say in the second quarter, there's an absolute home run. Well, what you don't want as an LP is to have invested, let's say, $1 million over 8 quarters. In quarter 2, home run, you get back the money you put into that Q2 fund. And then all of a sudden the GP gets a huge windfall and they're disincentivized and you haven't even made all your money back that you've invested with that GP. So by cross-collateralizing it, basically the GP doesn't get carry until they pay you back the capital you've invested across all of the quarters. So if you put $1 million in across 8 quarters, they basically got to give you $1 million back before they take carry. And so it is, think of it as a kind of a blank slate. You can customize a rolling fund to look identical to a traditional fund, 2 and 20 structure, 2-year investment period, 8-year fund with an extension. Or you can make it look something much, much different in a subscription model that's persistent forever and kind of looks nothing like a traditional venture fund. So by compartmentalizing every component of the fund structure and putting it into software, it basically has digitized this and added optionality. And so the reason why I like it is, as a GP and an LP, we double opt in every quarter. So I go and I make the capital call in quarter 1. When quarter 2 comes along and I make the capital call, LPs don't have to fund the capital call, right? And I don't have to call the capital in quarter 2. So if I'm not doing my job, the LPs aren't going to fund it. And if I think I don't have deals, I'm not going to make the capital call, right? And so it's a double opt-in every quarter. And so what I think it does is it strips away some of the things that venture capitalists have used for a long time to basically get rich, right? Is they just, hey, once you commit, it's basically an annuity for 10 years. And so by taking that away and saying there's this double opt-in mechanism, it holds the GP honest, and it also gives the LP lots and lots of optionality. And so the conversations I've had with the LPs who have invested in the fund, they are incredibly excited about that optionality. And then the icing on the cake is this is all done via the fund structure that allows me to talk about it publicly. So normally a manager can't go out and talk about the fund. Take somebody like me with large online audience, great distribution. I can literally just say, hey, I have a fund. If you'd like to invest and you're an accredited investor, here's the link. And so it completely changes the game for fundraising for individuals with that distribution.
How is that different for this? How come you're allowed to market a fund in this way, but if it's a traditional fund, you wouldn't be able to? What's the reg change here?
When you set up a venture fund, there's basically three separate types of regulatory structures you can use. One of them basically allows you tons of flexibility in terms of the number of investors and the amount of capital, but you can't say anything about it publicly. And then there's another structure that says, hey, you can talk about it publicly, but you only get 99 accredited investors, and then you get 2,000 qualified purchasers. Right, is kind of the structure, and so the rolling fund structure goes after that second bucket. And so far, look, I've been able to raise basically the equivalent of almost a $20 million venture fund, a seed fund, in a matter of literally weeks. It was raised, and I did one Zoom recording. Right, I basically had a very light deck, and then I answered a bunch of questions for LPs over email. Right, it was kind of the perfect type of experience for both the LP and the GP, where everyone felt like they had the information they needed. They also had access to get questions answered, but I didn't have to go do the traditional roadshow where quarantine would have prevented it. But like, go to everyone's office, sit down, do an hour-long pitch, follow up, do 6 different calls.
So much more efficient. I mean, we essentially raise all of the capital we've ever used for Real Vision in the same way, from our subscriber base, using the same regulatory change. So does that mean that for you to get the next round of investors in, you just launch a second rolling fund? So therefore you can keep talking about them, as opposed to once you hit the restriction number.
So I don't even have to launch another rolling fund. I can just, like, right now I have it shut. I'm not taking any new capital. When I'm ready to take on new capital, I can just open it up and say, hey, if you'd like to invest, you can go here. Once I fill out the full slots, I've saved some of the accredited investor slots because I didn't want to kind of sell them all out, if you will. And then from an institutional perspective, I basically have 2,000 slots. So, it's almost unlimited, right? It's so many of them. And so, at some point I'll turn it back on and say, hey, I'm taking more capital, and institutions can come in, they can invest. And the beauty for them is, if they say, hey, look, I was going to invest $10 million in an early stage venture fund, I was going to have a 2-year investment period. They just know on day one, okay, I'm basically going to invest all that capital. Instead of 2 years, I'm going to do it in 1 year. And that means I'm going to get a $2.5 million capital call every quarter. And at the end of that, I'll have deployed my $10 million, and Pomp will go out, he'll find deals, he'll deploy the capital. And, I can go into the AngelList portal at any time. I can see NAV, I can see the investments, I can kind of see all the information. And so what it does is it just drastically reduces the bureaucracy of kind of the world that venture capital has become, because basically GPs have 2 separate things they have to choose. You can choose to have a small team, but lots of kind of pain, right, in terms of reporting and access and LP communication, or you can choose to have a really big team and the GP does very little of that. And so naturally, if you have a big fund, you have the cash flow to build a big team. But what ended up happening was a lot of these micro VCs or kind of smaller sub $100 million funds, they just didn't have the cash flow to go hire a 10-person team. And so what they ended up doing is the GP does all the work. The GP sources the deals, the GP underwrites the deals, the GP negotiates, they consummate the deals, they do all the reporting, they do all the LP calls, they do all the fundraising. Like, it's a real big job, right? Now what AngelList has done, and they've done a fantastic job of it, is they basically have used software to solve a lot of those problems.
So what are you investing in the fund?
As I tell all the founders, hopefully they're all going to build billion-dollar businesses.
No, but what kind of areas, right? It's a big area, this whole digital asset space. What are you doing?
Yeah, so I'm basically spending, I would say, 3/4 of the time on Bitcoin and infrastructure related to it. And then I'm spending about 25% of my time in other early stage opportunities. And so, again, at the earliest stages, I just look for people who are super, super talented. And I frankly don't care what they go build. I just want them to be going after a big market. And what I've realized over time is, like, the founders are smarter than the investors. That's why they're going and betting their career. They're making a bigger investment than the investor is. The investor is investing money and a little bit of their time. The founder is choosing to invest majority of their time and maybe a little bit of capital. And so when you look at that in terms of a conviction bet, the founder actually is making a bigger conviction bet than the investor. And so whenever I see somebody who has a deep level of conviction around something, and I think that they're smart, they're a problem solver, they can recruit, they can raise capital, they can tell a story, like you almost are arrogant if you don't invest in them, right? Because what you're saying is this person who has such deep conviction to go spend their time on something, they're wrong. And that, when you frame it that way, all of a sudden you say, wait a second, like that doesn't feel right. And then the other piece of what I've learned over time is there's a lot of investors who optimize for batting average. I want to optimize for slugging percentage. I want to strike out a lot, right? But I also want to hit a lot of grand slams. And so you got to get up to bat when the bases are loaded, and you got to take home run swings. And so if you do those two things, then you got a shot. And so I'm more likely to invest in a lot of companies than a little bit of companies. And what I'm willing to do is say to the founder, your vision is what we're betting on here because you're the person who's investing the time. You're the one who's got the conviction. And so, in some weird way, what you're really doing is you're just helping somebody or facilitating them to go build their dream. Right? It is kind of how I look at it. And so you just got to pick the right people. And if you pick the right people, they take care of the rest. Yeah, you can be helpful. Maybe you can introduce them to somebody, give them a little bit of advice, be a good sounding board or whatever. But any investor who thinks they built the company is just full of shit, right? Like the founders built the company. They're the ones who did all the hard work. And frankly, the only credit that the investor gets is being not stupid enough to write the check in the beginning and then not sell because it's illiquid, right?
So let's talk about the super narrative, the whole kind of space. What is in your head? What do you think it's going? Because you're building businesses around it, right? I know what that means. That means you're looking for, positive funding ways of playing a super trend. Make as much money out of you can, number of ways. You've got a media business, you've got an investment business. I get it. Where is this space going?
Do you want the institutional pitch or do you want what I really believe?
What the fuck do you think?
I think Bitcoin's going to be next global reserve currency. And I think that every single person that's listening to this, every single person in the industry is completely underestimating this thing. I believe that Bitcoin is not only the hardest, soundest money we've ever seen in the world, but I think that it is the absolute apex predator in financial markets. And the reason why I think that is because there is one key trend that most people in finance don't understand. And it is the superiority of digital assets or digital products over analog products and assets. And so the technology industry is better suited to understand this component, which is if you look at store value and medium of exchange assets, historically, those have been analog. And then they basically became these electronic QSIP assets, which was just a kind of slight improvement on the analog version. So there was still middlemen, there was still a lot of bureaucracy, there was a lot of kind of human interaction, right? When you send a wire, in many cases, there's humans involved in that process. So it's not a truly digital process. The digital product is not only superior to the analog or electronic products, but it is also never. I literally cannot think of a single example where a digital asset is smaller than the analog equivalent. And so I always let's go to Bitcoin and gold. We'll start there. Gold has served as a store of value for 5,000 years. It's done a fantastic job of what it's supposed to do. It is not scarce. And the reason why I say that is because people claim gold is scarce, but it's a narrative. Gold has a scarce narrative. And we used to live in a narrative-driven world. That narrative-driven world would be somebody told you a story, and that story was believed because somebody else told them that. And enough people started saying it that they all started to believe it. But just because a narrative exists does not mean that it is true. And the reason why you cannot say that gold is scarce is because you cannot prove it. You may think it could be scarce. You may have data that suggests that it is not as easy to find as other assets, but you cannot prove how much gold is available. What you can show is, here's how much we've dug out in a certain time frame. But even to the point where I say, tell me how much gold is in the circulating supply. Nobody can prove it. People can guess, they can get close, but nobody can prove it. And so that narrative-driven world we used to live in got disrupted by the internet. The internet said we are going to drastically increase your access to information, and we are going to switch from a narrative-driven world to a provable world. You have to prove things now. You can't just rely on the narrative.
Yeah, that doesn't work. That's not true, right? I mean, we're just seeing what's going on in social media. We're still narrative-driven.
But that's why social media is breaking, is because the internet is able to show the narratives that we're told on social media from the existing institutions, politicians, etc., is a narrative. It's not true. I can prove that you are wrong. I can prove that.
But everybody will tell you you're wrong. You know, the weird thing is, right, when it comes to politics and who's right, who's wrong, everybody will prove something different. So I'm not sure yet.
But you can't prove two separate things. If you make a single statement, gold is scarce, and I say, prove it, you can't. If I say to you, Bitcoin is scarce, and you say, prove it, I can show you there are 21 million Bitcoin. I can show you the exact number in the circulating supply. I can show you the exact daily incoming supply. And if I say, great, this is Bitcoin, show me gold's equivalent. Nobody can do it. You have to put an asterisk next to every number and say it's estimated. Now, this is important, and this really, really upsets kind of the legacy finance folks, and it upsets the gold bug community. But the reason why it's so important is gold is a narrative and Bitcoin is provable. And the difference between those two things has nothing to do with the legacy world. The players of the legacy world, they think that the narrative has value. Their entire careers have been built on this. The next generation doesn't believe the narrative. The next generation says, prove it, and you can't with the legacy assets.
This is slightly disingenuous. Obviously, I agree about Bitcoin, so we're not going to argue about that. Bitcoin is a narrative too, right? All of these things are based on trust. And it's not the trust of the network and the scarcity, because we understand that that's provable. The trust is whether you'll accept it from me. And that's a narrative, digital gold, or whatever narrative we've all chosen right now. And because it is a behavioral incentive-driven network, that the more people come into the network, the higher the value goes. We're all incentivized to build on that trust layer by saying, no, trust me, they're all narratives. I mean, every exchange of value is a narrative because we have to believe there's value.
But I think the difference here is you're believing a narrative in the legacy world, because when I say to you, what is the dollar backed by? You believe it. Literally, the dollar says, "In God we trust." It is a belief system, right? It's backed by the government. Like, it is,
God.
Yeah, and so from the new thing is everyone wants to say Bitcoin's a religion, and I'm like, thank you. You're valid. You are literally validating Bitcoin as a currency, because every currency is a religion, right? Whether it's fiat, whether it's gold, whether it's whatever. The difference is not so much the belief or the narrative that you're talking about in terms of why somebody accepts it or why somebody doesn't. I'm talking about the actual asset itself. When you go and you look at the asset, you cannot prove, right, how many dollars exist in the world. Nobody knows.
So if you take the assumption that people are looking for a scarce asset, one is clearly superior than the other. On a relative basis, they're better than other assets because they have a more relative scarcity, and one's better than the other. Absolutely. On the religion point, I think about this a lot because there's a lot of this space I don't like. The religion part, I get it. Why? Because it's an incentive-based system. It's behavioral incentives. It's behavioral economics writ large here. So I get it. You need to defend your own network because that's where the value comes. But last time I checked, there was quite a lot of world religions and a multitude of gods. I'm still confused why people think there can only be one God in this particular space, as opposed to certain gods of different scales, the old kind of Greek or Roman style. You might have Zeus, who might be the king. How do you think about that whole thing? Because I know it's a hot potato right now. How do you think about it?
Yes, I have a very, I think, nuanced view of kind of where we are today, what's important, what's not, and then where we end up, right? And it's important to understand gold's kind of rise to prominence in the modern world. So gold served as kind of money and exchange of value for a very, very long time. It's hard to carry around, hard to divide, hard to just eyeball, how much gold is that? And so eventually we said, hey, look, instead of carrying this gold around, why don't we just leave it in a vault or in the bank, and we'll carry around paper claims on the gold. And I'll say, hey, if you sell me that horse, I'll give you my paper claims on the gold. You can go to the bank and you can turn in the paper claim and they'll give you the actual gold. And so that made commerce easier, right? The technology of the claim on the gold actually increased the velocity of money and the ease of use or the exchange of value. After we did that, we eventually then created this electronic QSIP system. We created credit. Like we built all these layers on top of gold as that kind of layer one technology. Now, in 1971, we decided we're going to unpeg gold from the paper claims and kind of all this stuff, went to the wayside. But that structure of layer one, layer two, layer three is really important because that's what's happening in Bitcoin today. Is layer one is optimizing for security and store of value. It's exactly what gold did. It didn't optimize for the fastest transactions or the easiest of use. It optimized for security and store of value. If you held the asset, you knew it was secure and you knew it would store value because of that scarcity narrative. Same thing here is if you look at Bitcoin, it is secure and it will store value over long periods of time. Now, what we're starting to see is layer two be built, right? So Lightning Network and a few others, Liquid, all these things. You'll eventually get layer three, layer four, et cetera. Now, most people put me in the camp of, oh, you're a Bitcoin maximalist. It's not really true. I believe Bitcoin is by far the winner, the king when it comes to the digital currency. I believe it will be the next global reserve currency. I think that's a foregone conclusion at this point. And so from a US dollar value standpoint, again, it is going to be worth multiples of where it is today over a long period of time. But I actually think that all this other nonsense that's going on has a purpose. There's a lot of experimentation going on. There's a lot of innovation going on, right? And what ends up occurring is that experimentation is going to eventually flow to be built on top of the hardest, soundest money. And so I used to draw this diagram of, let's say, decentralized finance, right? People don't like when I say it, but Bitcoin was the original decentralized finance. It is the most decentralized product in the space. So literally, decentralized finance was born out of Bitcoin. Now, what we're seeing, though, is Bitcoin, because it optimized for the security and the store of value, the development on top of Bitcoin is going to take a long period of time. And so what people did is they got impatient. They said, oh, we can't do this. We've got to go and we got to build this stuff now. So they wanted to do experimentation and innovation. So they built Ethereum and they've been building on top of that. We use that one as an example. Well, you have sound money in Bitcoin, but all of the infrastructure around Bitcoin for the most part is centralized. So whether it's exchanges like Coinbase, whether it's custody providers, whether it's data providers, whatever, it's all centralized infrastructure around sound money of Bitcoin. In the Ethereum world, you have decentralized infrastructure, right? So everyone's decentralized infrastructure, but it's built on top of something that is not sound money. Ether is no different than fiat currency. There's no cap. There is a variable monetary policy decision that is made on a periodic basis by individuals. Now, to their credit, they have made the right decision every time in that they continue to reduce the supply, but they have the potential to increase it if they wanted to when they make that decision.
Why does it need to be money? I don't get that. I don't understand that they should be competitive.
This is my point, is I believe that they shouldn't be competitive. But this narrative in the decentralized finance world, kind of the Ethereum DeFi world, that ETH is money, right? They say it all the time. No. It's not money, right? No. It's something completely different. And so what I ultimately believe will happen is you'll take Bitcoin, the asset, right, the sound money, and you'll take that decentralized infrastructure and you'll combine them. So you won't have the centralized infrastructure that's currently around Bitcoin, and you won't have kind of the unsound money of ETH. What you'll do is you'll take Bitcoin, you'll take decentralized finance, and you'll put those two things together. And what we will get is we will get a fully decentralized kind of financial system that uses Bitcoin as the core kind of currency.
This has been my point all along, is the collateral of the system will be Bitcoin.
Yeah, exactly. And by the way, that's not bad.
No, and everything around it can be built around it. And there's space for lots of innovation and a lot of different technologies, and there will be interoperability built across it. But the foundation stone is Bitcoin, because nothing's going to challenge that now as that collateral layer.
Yeah, and I think that the key piece, and this is always like my olive branch to the Ethereum community, and I'll get to it in a second. Your viewers will love for me to talk about why I disagree with a lot that's going on there. But the olive branch that I always extend is I say, listen, You guys have the right idea. And by the way, you've made a very rational decision to go build decentralized applications in the area that has the lowest friction to build them, right? In terms of from a development standpoint, it is easier to build a decentralized application today on Ethereum than it is on Bitcoin. But that does not mean that that is the ultimate final state. What we are already seeing, smart contracts are a great example. The smart contracts are starting to come over to Bitcoin, right? And you're starting to see all sorts of innovation around that. Now, smart contracts, Vitalik saw way into the future and said, hey, I want to have the ability to create smart contracts. And so he created a place to go do that. There's been lots of innovation around that. But ultimately what happens is people are going to continue to bring those innovations back to build on top of the hard money or that sound money. And so the reason why I think that the kind of Ethereum experimentation, while it is valuable and it is really important for the overall development of the space, the reason why I do not think it's sustainable, if you look at Bitcoin and its decentralization, it followed one key principle. It didn't take a single shortcut. It didn't do a single thing other than allow for natural adoption to occur. And it took a decade to reach any level of real prominence. And so when it started and Satoshi said, hey, I've created this thing, I'm going to put it out in the world, it was centralized. There was one person or one group that had Bitcoin. And then they sent it to the cypherpunk mailing list. And now all of a sudden there was 4 or 5 people, then 10 people, then 20 people, then 100 people, then 1,000 people, then 10,000 people, 100,000, 1 million, 10 million, right? And so it kind of naturally grew. We live in a world where we want to accelerate everything. We want to get everything now. We need to do everything right now. Bitcoin never took a shortcut. And so what it did was it got that natural adoption cycle of a technology. And today it's the strongest computing network in the world. It's completely decentralized. There's no one that controls it. And basically no one can screw with it, right? What's happening in the DeFi world is people know that they need the actual incentive for people to come in and adopt it. That's how they get decentralization. That's how they get utility from liquidity, all this kind of stuff. But rather than allow for time to expire and that natural technology adoption, what they're doing is they're taking a shortcut. They're using a financial incentive. And this is where you get into yield farming and all this kind of stuff. They're basically saying, hey, I want you to come use my product. So what I'm going to do is I'm going to create a bunch more of these tokens. And if you come use it, or you sign up, or you deposit, or you do whatever action I want, I'll actually give you a financial incentive to do it. That works in the short term because people come in, they want to profit, they're capitalists. But over a period of time, they just move on to the next thing that provides a better return. And so how many of these DeFi applications have we seen explode in popularity, and then people move on to the next one? It explodes, they move on to the next one. And so what I think the resounding message, and it's not like I had this idea, like I'm looking at this after the fact and having watched Bitcoin's adoption, is if you want to build something that sustains, not for 6 months or 12 months, I'm talking about something that sustains for decades. You can't take a shortcut in the adoption cycle because the bigger the shortcut you take, the more unsustainable it is that people will stay, right? And so if you use that financial incentive to get people to onboard really quickly, that just means they're less likely to stay longer because you're actually bringing the wrong people in, right? When you bring in people who are coming for a financial return, the second that something else comes along that provides a better financial return, they go there. And that's what we've seen over and over and over again. And so what I think is happening in some weird way is Bitcoin's adoption is continuing, right? We went from individuals on the fringes of society to kind of more of a mainstream audience to now an investor or retail audience to then an institution audience. I think eventually we're going to get corporations and then central banks. But as that adoption is occurring for the underlying asset, we now are seeing people who actually are creating decentralized infrastructure still in the early innings, but there's no tokens. There's no yield farming. There's no sort of financial incentive that is trying to circumvent or shortcut adoption. And so what ends up happening is DeFi has exploded in popularity and people have run there, but there are no applications. Not decentralized exchanges are different, but there's no actual applications using ETH as money that have any sort of sustainability to them. Those assets are actually, or those applications are actually going to be built on the asset Bitcoin. And so it's going to take a really long time. But I have no doubt there will be decentralized lending, there will be decentralized banking, there will be decentralized name your product from the legacy financial system. It's all going to get built. It's all going to be decentralized. The DeFi community has it right. They're just simply trying to shortcut adoption. And what they're doing is actually shooting themselves in the foot. And so now what you're starting to see is people build it for Bitcoin.
Yes and no, right? Because we've seen this. PayPal scaled their business this way, right? Many people have. Now, it's a very risky business because most of them fail. If you try and financially incentivize your customer base, most businesses run out of cash. Or, the other problem is with a lot of this early stage token stuff is VC opportunities were never supposed to be mark to market and liquid. And what happens is there's too much retail in the space. There's not enough regulation, in my view. What happens is these tokens go up too fast. Even the founders of the projects just sell them, flip for cash. And then you have to wait a 5-year cycle. Does this project survive or not? I mean, imagine if half these businesses, or even the businesses you set up, were mark to market real time. They'd have gone to zero about 6 times, right? It's a stupid idea to allow that to happen because you're attracting exactly the wrong sort of capital. As a VC, what you need is long-term capital as a VC. If you have short-term capital, it's going to destroy the businesses and the capital provider.
Yeah, and I think here's the other piece of this that is fascinating to me is, again, I think the people who are creating these projects and these experiments, they're actually being rational actors, right? So I tell them all the time, I say, listen, by the way, if you want to accelerate adoption of your project, your product, whatever it is, you should use the financial incentive. Just understand that by short circuiting the natural adoption of a product and technology, it makes it less likely that that person's going to stay over a long period of time, right? And so you mentioned PayPal, for example. The difference between, let's say, a lending protocol and PayPal is that PayPal actually is a true network effect business, right? The more people that are using it, the more value that you actually get out of it, virality of money. And so you want to have as many nodes on the network as possible because that gives you the most optionality as possible. These lending protocols or whatever the different products are don't necessarily fall into the network effect business. And so I always kind of try to really walk a fine line between saying, hey, all this stuff is not valuable at all, and there's no place for it, and people are wasting their time. I don't think that's the case. What I think you're going to start to see is over the next, let's say, 5 years or so, you're going to see many of the people who have built actually really interesting, innovative, super disruptive things just start to tweak them, whether it's through interoperability, whether it's they try to wrap Bitcoin and bring it onto Ethereum so that they can use it there, or they just say, hey, rather than build this in the Ethereum world, let's build it in the Bitcoin world. But I think ultimately where we end up, 10, 15, 20 years from now is there's decentralized infrastructure. So DeFi is right in that sense, but Bitcoin is the asset. It's not Ether. And some people think that's controversial. There's a lot of people, frankly, especially, some of the people who I find to be the most intelligent, most critical kind of first principles thinkers. They all tend to agree that that's probably where we end up here because it, again, just optimizes for the biggest value advantage or change, which is we go from using fiat money with an uncapped supply to an asset that is an artificially capped supply and has a completely programmatic monetary policy. And that is the biggest, most important innovation in this entire thing.
How are you thinking through the rise of the derivative market? Because derivatives, it's leverage, right? One of the great benefits we've ever seen was the invention of the derivative market. One of the worst things ever happened was the invention of the derivative market. Right, we're thinking utopian terms about can we construct a new financial system, but we're kind of humans. So we're going to over leverage it again and fuck the whole thing up. What do you think?
Yeah, so thankfully for me, I am somewhat self-aware in terms of my circle of competence and where it is not. Derivatives, I have no interest in. I have no knowledge or expertise there.
Call it leverage then. Let's just call it leverage.
The things that I see going on, especially outside of Bitcoin, right, is pretty crazy. But there's even some of it happening in Bitcoin specifically as well. And again, it ultimately comes down to I try to tell founders or builders, look, I have a really open mind, and I think that you should go experiment and try to build everything you possibly can. Like there should be no sacred cows. You should just go build whatever you possibly can, experiment. You want to try a bunch of stuff with leverage, knock yourself out. You want to try a bunch of stuff on some weird chain, whatever, go knock yourself out. But that doesn't mean that I think it's all going to work. But who am I to say, right? Like my opinion doesn't actually matter. It's what the market decides. And so when you start to realize that, if everyone wants to go use leverage in whatever derivative product it is, then the market is deciding that this has value to it. right? If everyone says, no, I'm not going to do that, then they're going to go and they're going to use something else. And so when it comes to things that I don't have an interest in, I don't have kind of any deep expertise or knowledge on, I just say, well, what is the market doing? And this is where you get into, like, maybe instead of derivatives, like you can look at like a decentralized exchange. It's hard to argue that Uniswap is not being used, right? Like Uniswap is being used by a lot of people. But is there a difference between Uniswap as a decentralized exchange and kind of all of the speculation and value transfer that crypto has kind of been built on over the last couple of years versus all of the different protocols, lending, and other decentralized products, right? I put those in two very, very different categories. The same way that you or I would say Coinbase is very different than other types of financial products, right? And so when it comes to derivatives or some of these other products, that stuff to me is going to fall way more in the camp of the financial community and also the trading community. For me, I don't trade. I literally have zero interest in doing any of that. What I'm more interested in is, for example, using the Bitcoin network, not the asset, but the network as a payment rail. And so can we go and can we disrupt all of the banks? Probably. Like we're an investor in a company called Zap. This kid, Jack Mahlers, who literally today, he can...
This is the strike thing, yeah?
He can sit down next to any other company in the world, and he can look them dead square in the face, and he can say, I can send $1 faster for free around the world than you can.
Yeah, that for free thing is a lie, right? You understand.
Why is it a lie?
Because you've got two bid offer spreads you need to cross. One is your currency, dollar, Bitcoin bid offer spread, Bitcoin bid offer spread, British pound bid offer spread. What he's doing is taking the money from the market makers. It's not free. It's like Robinhood is not free. You are the customer. You're paying their fees. So it's not free. And you don't know what the foreign exchange rate is. But it's very quick, very efficient, super cool technology.
If I send you $20 and you receive $20, is that not free?
If you're sending dollars to dollars, send dollars to pounds, there's an exchange that has to be paid.
Yeah, but now here's the whole thing, right? Is if you send $20 on Strike right now, if I go in the app and I say, hey,
which I can do with Tether, right? I could do with Tether to you. I mean, that's no different, right? That's pretty standard.
Well, if you did that though, you would have to go onto a crypto exchange. You would have to actually convert your fiat into a digital asset. You would then have to send the digital asset. The other person would have to have a digital asset wallet. They then would have to convert from that digital asset into dollars and then pull it into their bank account. With Strike, I say $20. I don't have to even know what crypto is. I don't have to know what a digital asset is. I don't have to know anything. It debits my $20 out of my account and it deposits $20 in your account. You don't have to have a wallet. You don't have to have a digital asset knowledge. You don't have to have anything. I send $20, you receive $20. Now, what is he doing in the background? He's absolutely taking dollars, turning it into Bitcoin. He's hedging it. He's moving it along the Lightning Network. He's switching it back. He's hedging again, right? So there's a whole bunch of complexity that he's basically kind of melted into the background. But I think the key to that whole thing is if he literally could send you 1 penny.
Yeah, and this is the key thing to this one, I think. It's the first true consumer app. We always said apps where you don't even know you're using digital infrastructure or Bitcoin infrastructure or anything is what needs to happen. And this is the start of all of that. When we don't even talk about protocols, and I don't even care if it comes across via Ethereum through nobody gives a shit because I'm sending you something, whatever the value is I'm giving you.
I think this is dead on, right? Is when you really understand it, and the internet's the quintessential example of there's a lot of protocols that are all talking to each other. There was a very serious protocol war, right, of who was going to win, and ultimately 5 or 6 of them won out. They're the most popular ones. Everyone uses them, and we're off to the races. I couldn't name them. Right. And 99.9% of internet users couldn't name them either. All they know is that they go on their computer, right? Most people don't even know what the browser name is. Do they use Google Chrome or do they use something else? They just know I go on the internet, I type in google.com and this thing comes up.
Even you and I speaking on Skype, on Zoom now, right? We're using different microphones that are using different standards. I'm on an Apple Mac. You might be on something else. all of this stuff we don't even think about. It's like I just turn my computer on and speak to you. It's like there's a load of connections, interoperability, layers. It's seamless.
Yeah. And I think that that's ultimately the world that we go to. And this, if you kind of zoom out just from kind of the Bitcoin world for a second, and you just say, let's just look at decentralization in general, right? I've said for a long time, I've continuously get pitched these like decentralized social networks and, decentralized, name your product, decentralized media company, decentralized this, whatever. I say, look, nobody is going to say, I'm on Twitter. Oh, you built a decentralized Twitter. Let me leave Twitter and go to decentralized Twitter. They're not going to do it. What you have to do is you have to build a better product than Twitter. And oh, by the way, it happens to be decentralized, right? The decentralization is the responsibility of the developer. It is not the sales pitch to the consumer. And I think that understanding that is going to be imperative for people as they begin to build technologies in this new world, because decentralization is going to be the default, but the consumer, in Jack's a perfect example of it with the Strike product, is the consumer doesn't give a shit what asset, what protocol, anything. All they know is if I go to Western Union, it costs 14% for me to send money back home. And if I use this thing, it gets there and they don't take any of my money. Like, that sounds like a pretty easy decision for a consumer to do, right? And so if you can get to that world, now what it does is it offloads the responsibility from the user making decisions as to, do I want financial privacy? Do I want decentralization? Do I want, all these different components? And it says to developers, you're going to have to build products that do it for the user without them realizing you're helping them. Right. And you're going to have to be able to be forward thinking enough and confident enough that you can build a business with a product that maybe you don't monetize the user information, or you don't look into their financial information. You actually do things the right way and have that 30 plus year view of building your company.
Or there's an applications layer over the top, like VPNs and stuff like that we can select our own level of whatever basket of stuff that is important to us. Decentralized, non-decentralized, data sold, non-data sold, private, non-private, and there's trade-offs. And individuals can have their trade-offs, I guess.
Absolutely. So I think if you said to be like, paint the picture of where are we going, 20 years from now, I think that we are going to have a completely decentralized financial system. Bitcoin will be at the core of it. It will be the core unit of account, be the global reserve currency. And a key piece to this world that doesn't get talked about enough, but I think it's very important, is it will be an automated financial system. And that automated financial system is, today, you can't have automation because there's too many human processes involved, right? If I want to go and I'll give you another example. If I want to go and I want to get a mortgage, for example, I can't get a mortgage in the United States without actually interacting with somebody until a company called Figure came along. And what Mike Cagney, the former founder of SoFi, where we're an investor, what he created was you could go online, you could fill out an online application, and within 5 minutes, they would tell you whether you're going to get the mortgage or not, and they would fund it within 5 days. Now, how do they do that? They say, okay, go on, you start filling out the application, and rather than you say, I swear on my life, I am employed at X company, I make Y dollars, and I'll get you that information. And then you go and you get your employment letter, you go and you get your pay stubs, you get your bank to give you a customer letter or whatever, and they send it all in. No, what they do is they say, hey, you should, via Plaid, just sign into your bank account. Just put your username and password in. And when you do that, well, you just signed it. So you're definitely a customer of the bank, right? 2 is they then quickly scan all your data and they say, what corporation is direct depositing every 2 weeks? Oh, well, that must be where you work, right? High degree of confidence on that. And then, by the way, I don't need an employment letter and I don't need to know your pay stubs because I can just look right here. This is the exact amount that's hitting your bank account. So that's a perfect example where like they automated that process from a paper process and a human review kind of confirmation process with technology. And that has nothing to do with blockchain. That has nothing to do with crypto. Like, that is just pure technology versus, bureaucratic type process. I think that is going to be pervasive across the financial industry. And so this automation system that we have now, we can actually get a world where if there wasn't some regulation, there's a regulation where there's a cooling off period in that mortgage process, where I think it's like a 3-day cooling off period. If that regulation wasn't there, from a technology perspective, Mike and the Figure team could literally say, apply. We'll tell you within 5 minutes whether you're going to get it or not, and we will fund it in 5 minutes. So literally, you can go in, you can apply. We'll tell you within 5 minutes, and we will fund it in 5 minutes.
And you'll be able to pay for the house instantaneously too.
Yes. Yes, exactly. So again, we are very far away from this world, right? Like there is a lot of work to do, but it is not just a technology build that needs to happen. It's also, we've got to get the incumbents out of the way, because there's a lot of incumbents who have a financial interest in not seeing that world come to fruition. They actually make a lot of money by not allowing that type of innovation and progress to happen. And so I think that what we're going to see here is we're going to see two competing forces. We are going to see, Silicon Valley versus Wall Street. And that's a very big overgeneralization, but just the technologist versus kind of the old school banker who they actually have a business model where inserting themselves in the process, creating bureaucracy allows them to kind of take a tax or a transaction fee on all this stuff. And so again, I can't predict the future, but what I can tell you is based on historical context and precedent, the technologists always win. And so you can hold on for a while. And I don't know, maybe the kind of banker world can hold on for 5 years, 10 years. Maybe they can hold on for 20 years.
Or maybe they adapt.
So when you get to, let's say, Goldman Sachs been around a long time. Goldman Sachs was around before the internet, right? Goldman Sachs was around before fiber. Goldman Sachs was around before telephones and kind of the telephones we know today, right? Like they were around before mobile phones. They have adapted to every single piece of technology. But what they also did was they adapted their business model as well, right? And so I think what we're going to see is a haves and have-nots in the financial world. The people who hold on forever to the old model will get disrupted. And the people who are forward thinking, many that you can, Fidelity is a great example. They're like all in on this stuff. They say, hey, of course, this is going to be a thing. Let's be ahead of the curve. Let's embrace it. Let's figure out how we can build a business around it. And let's go kind of be a leader in this space. And so that split between have and have nots will open the opportunity for new challengers to eventually become incumbents by building super valuable things that replace the have nots and ends up creating kind of this decentralized financial system that I'm talking about.
Yeah, I mean, if I look at that world and I see the adaptive, call them the investment banks, because they tend to be more adaptive, and I look at the central bank digital currencies, I'm like, so where's the normal money center bank? Because literally, they're not going to exist. I cannot see a role for them. And I kind of think the Europeans know that, and they're working to do it, to get rid of it.
So one of the most interesting frameworks for me to talk with kind of legacy finance folks about is, if you're over the age of, I don't know, maybe 40, 45, your entire world you grew up in, there was a very high friction to switching currencies. So if you were a macro trader or a foreign currency trader, you had the technology, the systems, spent a lot of money in R&D to be able to do this somewhat seamlessly because you were trading it. But for the average person, the only two ways to switch from, let's say, US dollars to another currency was either to physically go into the bank and actually say, hey, I would like to take my US dollars and get euros. I'm going on a trip, and they would say, how much do you need? And they would change it out. Or you could go get ripped off at the airport by a currency exchanger, right? Like those were basically your two options. So very high friction, very expensive. Well, when we move to a world where all of these currencies are digitized, so there's a digital dollar, a digital euro, all the private currencies, Libra, and all the other ones that are going to come, and then you have decentralized currencies like Bitcoin, the technology layer is basically going to be feature parity to some degree, right? Maybe there's some nuance here or there or whatever, but everything ends up being digitized. Now the switching cost between assets is drastically lowered, if not removed. And so what that changes is we've lived in a world, I call it a single currency world, for pretty much everyone's life that's alive right now. If you get paid in dollars, you hold your money in dollars, you pay other people in dollars, and you denominate all of your assets in dollars. If you maybe are on the fringe and you live in a world where your nation state currency hits hyperinflation or gets devalued away, you then switch out, right? But again, you don't go to, hey, I'm going to take my one currency and swap it for 6 currency. As you say, I'm going to take my one currency and switch it for another one currency. And now I live in a single currency world again. When you reduce the friction of switching between these currencies, there is going to be a world where likely I get paid in dollars. But just because of a digital currency doesn't mean that it changes the monetary policy. It's a technology change. It's not a policy change. So they're still devaluing it. They're still printing it. In some ways, they may be able to print even more of it because it's easier to do and all this kind of stuff. But when I get paid in dollars, I'm not just going to simply save my dollars and leave them in the bank. I'm likely with the click of a button to switch it into a better store of value digital asset. So let's say Bitcoin is that asset, right? So I go from digital dollar to Bitcoin. It's a one-click thing. And now I'm using the store of value or the purchasing power protection of Bitcoin while I'm not using my dollars. The government says, but you know what? When you pay me in taxes, you got to pay me in dollars. And so when I go to pay my taxes at the end of the year, I then switch back with the click of a button from Bitcoin into dollars and I pay my taxes. And so I'm actually living in a multi-currency world now where I'm able to switch in and out. Now, most people are not going to be currency traders. They're not going to be super sophisticated about this stuff. And so my prediction is that actually we're going to see a bunch of technologists build things that just auto do this for folks, right? They say, hey, when you get paid, it's going to go sit in this savings account. That savings account is going to happen to have better purchasing power protection than if you just sat with dollars. And then when you say, hey, I want to pay something, they'll just auto convert you back into a currency. You won't know the difference and it'll kind of just auto magically happen for you. The key to it, though, is we are underestimating what this provides for central banks. Central banks are about to have the ability to create personalized monetary policies.
Right.
And this is going to screw up a lot of people because we've always lived in a single monetary policy world as well. So the individual lives in a single currency world and the central bank lives in a single policy world. Well, when all of a sudden you now get individuals who can live in a multi-currency world and central bankers who can actually have multiple monetary policies. And for those that don't know what that means, basically means I can treat, let's say, rich people one way with monetary policy, and I can treat poor people a different way and the middle class with something else. I can say, if you are of a certain age, of a certain demographic, of a certain income level, of a certain geographic location, of a certain occupation, right? All these different things, of a certain spending habit, I can give you a different monetary policy than somebody else.
And a different fiscal policy too, probably.
Absolutely. Now we enter into a world where there is much, much more competition. And when we have much more competition, you also get much more optionality. And so the saving grace of this could be that all the central banks say, oh, wow, I have to compete with everybody else. I should probably behave myself. But as we know, the incentive is too strong. They say, I can abuse my power. Oh, there's people won't go over here or people won't go over there. I'm going to abuse my power because there is a financial incentive for me to do it. And so I think that you're right in that the central banks, by digitizing their currencies, are actually accelerating the inevitable, which is that ultimately these currencies are all going to be interchangeable with each other. And not only are they going to try to use this multiple kind of monetary policy world to their advantage, it's actually going to force people to go find a single currency world like Bitcoin that has that purchase power protection. And as you get more and more adoption, you get more liquidity. As you get more liquidity, you get more utility. As you get more liquidity and utility, you get more stability as well. And I think that that key piece is today we have up to maybe 100 million people using Bitcoin. When we have 1 billion, 5 billion, 6 billion people who are all holding this asset, it's not going to have 30% drawdowns. Right? It's just simply you're going to literally have a switch.
Yeah, it's going to be a 3 or 4 volt asset. It's going to be very non-volatile.
Yeah. And you're also, again, nobody talks about the dollar crashed. I've never heard a normal person outside of finance say that. No one's ever said, oh, the dollar crashed today, right? No, what they say is, hey, I used to spend $3 to buy that loaf of bread. Now I spend $4, right? It got more expensive. That's about the only thing that they'll say anything to do with purchasing power. Well, we still price assets today in dollars. And it is coming. It is absolutely coming. As soon as we start seeing corporations reporting Bitcoin on their balance sheet as part of their reserves, you're going to start seeing corporations pricing goods in Bitcoin. And they'll start with super fringe, weird things, almost like gimmicks, right? They'll say at the baseball stadium, oh, come buy the Bitcoin hot dog, right? And it's, 100 Satoshis gets you the hot dog. And people will laugh and they'll buy it. And then all of a sudden it's the soda as well. And then it's the fries. And then it's the peanuts. And then it's just the ticket to the game, right? And then it's the salary for the player. And it's literally the revenue of the team. And so that may take 10 or 15 years to happen. But when we start pricing things in Satoshis, what you're going to see is all of a sudden that volatility basically gets masked, right? Bitcoin only dropped recently 20% in US dollar terms. In Bitcoin terms, it didn't drop. 1 Bitcoin equals 1 Bitcoin. It's just like dollars. $1 equals $1. It's not about did the dollar drop. It's did the dollar become less valuable compared to goods that it wants to buy or services it wants to buy? And so that's the big leap, right? That's the one that scares everybody around like, wait a minute, I denominate every asset in my life in dollars. When I have to start switching and I denominate everything in Satoshis, what happens? And I did this about 2 years ago. I started to think of everything in Satoshis.
Yeah, I mean, look, it's way too early for that. We're nowhere near it on the network effect. So yes.
Agreed.
But as a European, I've gone through this. We had currencies, and then they changed to other currencies. It didn't take long before we went from pesetas to euros. The old people, they kept calculating everything in pesetas. Pretty much within a year or two, everyone got used to the euros and forgot about francs. So it actually doesn't take that long. What it took was a concerted change, which was the ECB. Not to say that may not happen. As you alluded to earlier, some central bank somewhere, according to game theory, is going to stick this on its balance sheet, and then somebody's going to peg themselves to it. Not with a 69 vol asset, not right now, but at some point, it'll certainly go into the balance sheet, and then at one day, somebody just say, oh, we've decided to adopt the Bitcoin standard, and there you go. And that's the start of the great game.
So we're recording this in January of 2021. I think by the end of January 2022, so basically 2 years, give or take, there will be a material percentage, and probably not 50%, but somewhere between, let's say, 10 to maybe 25% of Fortune 500 companies will have Bitcoin on their balance sheet in some form or fashion. And when you think about the importance of that, you're now talking about every shareholder is seeing Bitcoin on the balance sheet, every executive, every financial show is talking about it, right? All these different things. And so when you start to think about the adoption that is still in front of us, right? People see Bitcoin, ran all the way up to $40,000. Oh my God, it's a bubble, it's over. This is going to be the all-time high. We haven't even started yet, right? Like when you really think about it, we have not even started yet.
But there's something interesting, and I was thinking about this from something you were saying before. Right, it's interesting because most network effects remain exponential. But Bitcoin has this kind of S-curve in price. And the reason being is because we all still work in our fiat currency home base. So at some point, it creates enough value for us that we go and buy a house or a car or a Lamborghini or whatever it is. But at some point, you won't see that drawdown. And that's the point when people say, I don't need to capture value in dollars. My value remains in Bitcoin. I know some people are there now, but you'll see that from when the sell-off after the halving, the usual kind of cycle goes. When that's gone, it's going to tell you something.
One of the key pieces that is happening now, but not being discussed, but I think is being undervalued, is we, meaning you, I, and most people listening to this, we think in terms of markets, the finance world, or the technology world. So we think very much corporations, what are venture capitalists, what are hedge fund managers doing, how are asset prices moving, markets, all that kind of stuff. One of the blind spots for the tech industry and for the finance industry is what many people refer to as kind of the culture, right? So this is music, this is athletes, this is kind of all of the things outside of technology companies and outside of kind of finance companies. The culture, right? It's usually like hip hop community, professional athletes, all that kind of stuff. They are obsessed with this, and they're starting to talk about it, and they're starting to use it, right? Cash App is a great example. Cash App's demographics look very, very different than pretty much any other financial community. If you literally, there's songs about it, right? There's people who say, I want, like, pay me on Cash App, all this kind of stuff. And so when you start to see culture shifting towards something, that's when you really get the flywheel going. Because it's one thing if, Mass Mutual says, hey, I'm going to go put $100 million on my balance sheet.
Most people don't care.
If a tree falls in the forest, did it really fall, right? It's kind of the thing. If all of a sudden Drake says, pay me in Bitcoin in a song, people start paying attention, right?
Although most of us in financial markets are slightly nervous of that one, because when Giselle asked to be paid in euro, I remember I changed my entire billing of my business into dollars. I was living in Spain. I changed my entire life savings. It was at 148.5. It was a home run of a trade. So it worries me when these guys want to get paid in Bitcoin still.
But it's going to happen, right?
But it's true. I get the point. I mean, it's a real point.
Absolutely. And so I think that like I have enough data points now, enough conversations, whether the musicians, the professional athletes, or kind of, the YouTube world, the TikTok world, all of these people are starting to say, wait a second, what is this thing? Why is it important? And to their credit, many of them aren't just buying it. They're not just seeing it and saying, hey, I'm going to buy this, right? They're actually doing the opposite, which is they're saying, hey, this is interesting to me. I don't understand it. Can you teach me? Can you educate me? Right? Can you get me up to speed? And so if they were just running out and buying it and looking for it to double, that would scare me, right? That would basically tell me, hey, they're just speculating and it's no different than gambling. But when they say, explain this to me, why is this important? Oh, I didn't understand that the dollar gets devalued. And if I just sit in the bank account, I lose purchasing power. And they really start to like understand it. You then begin to realize, wait a second, that's more likely to be a sustainable user over a long period of time. And if they have influence, if they have audience and they're able to, one, get over the hurdles and kind of understand and educate themselves, and then they begin educating other people, this flywheel can really start to run. And I think that it really only takes, two or three big people, right? Again, I use Drake as kind of an example of a lot of people paying attention, pretty forward thinking, likes to be seen as kind of on the cutting edge of innovation. You take somebody like that, he said, literally comes out with a song, pay me in Bitcoin. All of a sudden, you're like, whoa, wait a second. People say that's impossible. That's not going to happen anytime soon. Well, Russell Okong, an NFL player, tweets almost every day, pay me in Bitcoin, right? And it's literally on national television saying, hey, I'm taking half my salary in Bitcoin. And so I've already seen multiple players tweet at him saying, what's this Bitcoin thing? And so even if only 10% of them actually take the time to get educated and start adopting it, you're going to watch this generational shift where people grow up with this being a part, maybe not majority, but a part of their life.
So just to play devil's advocate, I kind of agree, and this article will shift that way. Problem is Bitcoin goes down 90%. Let's say it doesn't. Let's say next time around it goes down 60% and stays down for 3 years. If you're an NFL player, you're going to feel really stupid because you've halved your salary, right? Because your base currency that you spend is dollars. So it's hard until that volatility goes. And for that volatility to go, you need more adoption. It's a bit of a tail wagging the dog, but it's going to take a bit of time.
But I disagree with that for one purpose, right? Which is if you had bought Bitcoin at $20,000 in July 17, or in December 17, and you had continued to buy Bitcoin, the same amount every week, all the way down through the bear market, you would have been up like 40%.
Yeah, but
right?
You're an NFL player. You're spraying it on champagne in nightclubs. You spend all of your cash every month, and then every month your salary goes down because Bitcoin's in a bear market, right? That's the truth.
The people getting paid in Bitcoin, they're not the ones spraying the champagne. There's a lot of those guys, but the ones who are saying pay me in Bitcoin, they're the ones who are a little bit more financially responsible, is what we could say. But your point is well taken that, yes, absolutely. There are some people who, with the volatility, that will be a negative, right? And then there's some people who basically say, Russell's a great example. I don't want to speak for him, but I think that his perspective of like, hey, every time I get a paycheck, it's going to be basically split 50-50 is my understanding of what he's doing. And he's essentially just dollar cost averaging into the asset over, however many years that contract is. And so while there is volatility and it can be a negative, if you take that approach, historically, it's proven to work out.
That's like a 401k, but just 50% of your salary. So, why not? Makes total sense. Listen, my friend, I've kept you for 2 hours. It's been a fantastic conversation. We talked about all sorts of stuff. Lots for people to dig into. And look, I really, as ever, appreciate your time. And I've thoroughly enjoyed it. It's been super interesting.
Listen, thank you for doing this. I was excited to see you and Real Vision start to cover Bitcoin and crypto because there's a certain type of audience that I think you guys have that they're not going to go on Reddit. They're not going to go on Twitter. They're not going to go kind of to the corners of the internet and find information, right? What they want to see is they want to see you and a whole bunch of your colleagues or the kind of guest hosts that you have talk about this stuff. So just keep it up. And I appreciate you taking all the time to learn yourself and also educate others.
Yeah, thanks. We're all building the network effect in our own way, right? We're all building our little corners of the universe to spread the word.
I couldn't end it any other way than long Bitcoin and short the bankers.
Take care, my friend. That was great. See you soon.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.